What's up, everybody? It's Stephen A. Williams, president and founder of the creditrepairshop.com. In today's video, we're going to talk about FICO 9, how you can utilize the changes to benefit you with your credit. And I'm going to tell you some things that they're looking out that you need to be aware of, that creditors are looking out for, that could affect your credit scores. And also, I'm going to talk about FICO 9. FICO 10. Not too many people know that FICO 10 was introduced. And I'm going to tell you some of the things that they're utilizing in FICO 10, where people with good credit might be thinking they're getting away with something when they do something, but the algorithm can actually work against you. I'm going to go into that also. First, just in case you haven't seen my other videos, Happy New Year. I know I've been away for a few days. I had all 5 grandchildren with me. All 5 grandchildren with me for the entire weekend. You know, I love the kids. I love my nieces, nephews, and obviously my grandchildren. 4 boys and 1 girl. And trust me, I was with them the entire time, playing with them, games, sitting with them, watching them play their games. Like I just took it all in, and I didn't even really, I didn't do no work. I'm just be upfront and honest with you. I didn't do no work. I didn't think about no videos or nothing. I just thought about being with my middle daughter was in town, and her 2 kids, and then my youngest daughter with her 3 kids. They live in town, but we were all together, and we enjoyed it. So now let's get into it. Let's get into it. First, I need you to like this video. I got to get my likes up. The content is good. Content is unique. I put my own, spin on it, which is done from research and also done from dealing with hundreds of thousands of customers. That's something that I think is different than what you see with other people who have channels, is that they're basically working off of what they just read. And that's not bad. We need to read, we need to understand, we need to look at things, but also the application of that information it can look a little bit different when it's actually applied to individuals, because everyone's credit is different. So let's walk through it real quick. I did some videos, and I want you to go back and look at the video that I made about the FICO scores. Recently made it, I think it was earlier, beginning of the year, where I walked through the different FICO scoring systems. And but a lot of people had questions about the FICO 9, because that's mainly where where everyone is dealing with, because the other scores is mainly the other older FICO scores. FICO scoring systems are mainly being used by mortgage providers, and if you're not going after a mortgage, you're going to mainly fall within the newer FICO 8, FICO 9, or FICO 10. But so let's go through it real quick. The main points, like paying your bills on time, not getting too much debt, not utilizing too much of your available credit on credit cards, all of that stuff remains the same. Not having collections and all of that stuff, a lot of that stuff remains the same, but the impact changed a little bit depending on what type of collection it is. And also the impact changed on if you paid the collection. Like, a lot of people get worried when we do settlements for our clients, and they're like, well, they didn't remove it. I'm like, well, think about it this way. When you're trying to get something removed, listen to me here. Listen to me here. I'm going to give you a little insider back and forth of what goes on when you're negotiating with a debt collector. If you walk up, let's just say that you're the debt collector. Sit in that debt collector seat, and I'm you. And I say to you, Mr. or Mrs. Debt Collector, I want number one, I want to settle this debt for less than what's owed. Okay, so now I'm asking you to do something for me. And then I also want you to take that off of my credit report at the same time. So now me wants you, Mr. and Mrs. Debt Collector, to do two things for me, and I'm just going to pay you the money, and I'm supposed to do that one thing. You know how everybody's mind thinks. First thing, what would you be thinking is you would be thinking, or you may not, you're going to be thinking this. Either that person's trying to get something and having this on their credit is messing them up. They can't get it. So that gives me more leverage. So debt collector, you come back to me and say, no, I won't remove it. Or I'll remove it if you increase the amount. And that's what happens with that back and forth. And that's a logical back and forth. For some reason, when the individual is in that seat, they don't see it that way. They think just because they bought it for pennies on the dollar, that means nothing because they're trying to maximize the return on their investment. So that does not matter. So you have to be very careful when you're in these negotiations. That's why we tell people you may not want to do your own negotiations unless it's for smaller amounts, because you can end up in a situation where they say, hey, we don't even want to settle it. We want to go for all of it, because if they know or feel maybe that you're going to go get a house, they can run your credit report, do a quick trace on there, and see the inquiries that you have. And if they're from mortgage providers, they're going to be like, well, we want to get more, because we know we have you by the you know what, and you're not going to be able to get approved, or you're not going to be able to get approved at the rate that you want because of the information that we have on there. So no, I don't accept your offer. We won't take it off your credit report unless you pay 100% of the debt. And that's what ends up happening with people. And that's why you have to be very careful. We don't get our clients in that situation because we tell them specifically what to do and what not to do, especially if they're trying to get a home. We tell them don't do that until we get all of this other stuff resolved. So now let's get into this here. With the FICO 9 change, especially due to COVID, especially just because people have overwhelming medical bills, the third-party medical bills will not count the same way that they counted with the other FICO scores, but they will count if you're trying to buy something, especially like a home, because they're going to say they're going to try to come after you for those medical bills. But now, look at this. Keyword is third-party. Third-party medical bills will not have the same amount of weight. And also, third-party medical bills that are under $500 are not even allowed to be on your credit reports, but we do see them on people's credit reports, and we instantly get them removed because we tell the furnisher, which is the third-party debt collector, that they have broken the Fair Credit Reporting Act, the new law that states that they're not allowed to put those medical bills on there, and they will remove them. Now, but that's just part one of dealing with medical bills. The next one is unpaid direct medical bills. This is like if the hospital contracts with a debt collector and the hospital puts that information on your credit reports, that medical bill can be placed on there. And a lot of people don't know that this is different. They can put that medical bill on there that is under $500, because some people will be like, well, there's a medical bill on there for under $500. Why are they able to do it? Because they didn't look at what it states right there with the third party. I'm going to utilize my colors here. They don't look at this here. Is that it's third party. They don't understand that it's unpaid direct medical bills is with the furnisher. That's the difference. But let me tell you how to get that information off if the furnisher does this. When we're talking about the medical center, is that if they used any name of the procedure that you received, that's why you'll, like, some of them know about this, maybe because we've put them on notice and actually gotten claims paid off because of what they've done with this. Some of the hospitals decided to just forgive the whole debt. But if they put on there the procedure that you had, because hospitals are like pieces some of the times. They have this department, that department, and they put them all together and it forms the hospital. So if they have the radiology department, or they have the cancer department, or they have the transplant department, and then they put some, or medication, and they put that unpaid bill with that information on your credit reports, they violated the HIPAA Act, which protects you from having your medical history disclosed. And a lot of people don't know that. A lot of people know about the HIPAA Act, but they don't know how to utilize the HIPAA Act to get the information off the credit report. They just think they just can't put the information on the credit report. They can put the medical center on there unless the medical center has something to do with what they did for you. What is that, the one where they look inside, gastric something or whatever that is. Like, they can't say gastric clinic, because that's telling that's disclosing a procedure that you had. Now, if they just have just a flat out name, then you're gonna be dealing with those medical bills. It's gonna be a little bit more difficult to get those off of there, but the weight against you still with the FICO 9 won't be as much as it was with the other FICO systems. But with both of these, something that seems to get lost, with both of these, that does not necessarily mean that the debt goes away just because it's off your credit reports. As a matter of fact, this information, if it's taken off of your credit reports the wrong way, could still be revealed mainly when mortgage companies go to look at your reports, because there's going to be a little bit more data on there. Mortgage companies' underwriting process will care about these. A credit card company or auto dealer, they're not going to care about those, even though they're going to be able to see that those items were removed. It depends on the length of time. Now, another thing that FICO 9 added in there is that rental history. And with my research, something that I found that will help you if you don't own your home is that if you put the rental history on your report and you have limited credit history, let's say that you're rebuilding your credit and you have limited credit history, and you put your rental history on your report, you get that placed on there by using third-party furnishers, it will actually give you more of a bounce than it would if you had other credit history. That's kind of crazy. So they're actually trying to help you out with the FICO 9 when it goes to people who have rental history, maybe because they've left people out that have been paying their rent on time for years and years and years. They decided that in the FICO 9, what they were going to do is they're going to give you more weighted history, give your history more weight if you don't have that much stuff on your credit report. So, for example, let's just say you cleaned up your credit. You might have a credit card on there, and that's it. Credit scores may be in the 6s. You put that rental history on there, it would be like putting an AU trade line, but it would be like a primary, because that's your rental history. It's going to jump it. It could potentially jump from what I've seen 50 to 100 points by just adding that on there. If you have limited, now listen to me, if you have limited credit history, limited. If you have credit history, and this is just the way that they wrote the algorithm, if you have 5, 6 credit cards, you're still keeping those okay, but you're keeping them under that 30%. Your scores are going to be okay, and you add that rental history on there, it's going to give you a nice bump. It's not going to be as much of a bump that you would have got if you didn't have other history. I don't know why they wrote it that way, but it must be a way of benefiting individuals. Now, these are the major things. So watch out for this. Everything else remains the same, but this is giving you more details about how these three work, and also with the apps. I don't know if the apps are going to give you more, if they're going to give more weight to where, like, say for example, you have Netflix and all of these other subscriptions that you pay, you've been paying on them for years, and you have that added on there with the different products that are available in the market, and you had no credit, and you put your rental history, would all of that combined even give you more of a bump? We don't know. If you've had that experience, please put that in the comments so we can, get more information out to individuals about that type of a bump that's possible if people have that situation. Now let's talk about FICO 10. FICO 10. A lot of people have not heard of FICO 10, but let me tell you what they've done with the FICO 10. This was very interesting when I read up on this. So FICO 10, just like the other ones, payment history, paying on time, balances on credit cards, all of that stuff, that type of stuff remains the same. And then we add in the part about the rental, utilizing apps, and the medical bills and stuff like that. But this is something that was kind of, when I read it, was this here with the personal loans. How they always say that, they're like a step ahead of everybody with this stuff. When they put together these algorithms, it's like they're a step ahead, and they also do this in the interest of the lenders. It's not necessarily in the interest of us, the consumers. Yes, it may put us in a position to be able to utilize the system and be able to get us in a very good position to get loans or to get, business loans or whatever you want to do with your personal credit. But it's still, the scale is still weighed towards the people, the businesses that are that are doing the lending. And so what they've done right here is that they've added this section in there with the weight on personal loans, and it says especially used for debt consolidation. Because, one of the tricks that a lot of people do is they'll get a debt consolidation loan, have one monthly payment, and they pay off all of the other debts, and now they have just one payment with, one amount, and it's under a personal loan category. But what they're doing, which is something that they didn't do before, is they're looking at what you utilize that debt consolidation loan for, and they're putting that into the algorithm to see, okay, if it's not as if they just paid off that debt, they actually combined the two, and they're like, they got that personal loan to pay off the debt. So they wrote the algorithm to say, what is the risk factor of this individual knowing that they got the personal loan, but still with the debt that they paid off? They're going to look at what was trending with that debt that you paid off with the debt consolidation loan. Because people who get a debt consolidation loan think that you're just running away and it's going to look all good on their credit. You hear the commercials and they're saying, hey, have one low monthly payment, pay off all of your other debt. It's just going to one spot. And as long as you don't get in trouble, it's not going to matter. Don't go and charge up those cards again, or you're going to have the debt consolidation loan and the new credit card debt, which is what like 95% of the people do when they get debt consolidation loans. But what they're doing that they didn't do in the other FICO scoring system is they're looking at what you paid off, and they're assessing the risk based on you on that. So your scores could actually drop where you're thinking, I paid off all of these cards and everything, and my score dropped. It's because they're assessing that you could be a high risk because, in a way, and if you think about it, let's get back in that seat. You're that lender in that seat, and I'm the I'm you, or I'm the consumer. Hey, I want to get this loan, and here's my credit reports. And then, it looks all good. I just got this one personal loan on there. That's all I have. Everything else is paid off. And then they look at it and they're like, oh, that is great. You had all of this other stuff that was over here. That they don't, you're not saying that to me. You're just looking at the piece of paper. You're looking at the piece of paper saying, this guy think he's fooling us. You had all of these credit cards over here. He paid it off with this debt consolidation loan. And now that we have FICO 10, it's assessing that, hey, if he didn't pay off that stuff with the personal loan, this person was heading in the wrong direction. And now that they paid off all of those with that personal loan, what do they still have open over here? And see, the thing is that that a lot of people don't know is that these FICO scoring systems don't just give a score. It assesses the risk of that individual. It's like saying, hey, this is what they did. This is what we think could potentially happen if you give them that loan. They're assessing the risk of the individual. That's what the whole FICO scoring system is about. And now that goes into the next thing right here. Month-to-month trended data. Now, you have month-to-month trended data, and then you have the trended data where they're going to look at 24 plus months. On your credit reports, you'll see that it usually just has 24 months. But what they're going to do is they're now adding into their 24 plus months, and they're going to put more weight on that than they used to put on that. And that even makes it worse and could make your scores go down. I hope the glare is not, because I can't even really see right here up the glare on my screen. It is not about to happen because the sun is coming up over here. But something that is about, that will happen if you see your scores go down is that, remember when I told you about a late payment? If you had a late payment and you did all of these in a row and then you messed up on that month, that it would take you a whole, if you messed up one time, you need 24 months in back of it just to erase that. But what they're doing with this new model is that it's going to even make it worse. So if you messed up back here, I don't know exactly yet how long, but if they're going to figure 24 plus months, they're always vague with this stuff. I don't know if they're going 36 months. I don't know if they're going 48 months. I don't know how many months they're going to go. But having that trended data in there, this is how they're going to figure the risk factor on giving all of us loans if we want to get loans. But also, it could make your credit score go down because, say, for instance, you've already cleared the 24 months. You've cleared it from that late payment that you had when you got sick. But if they do 24 plus months on the new trended data, it can bring you back up to here and it can make your score go down. It can make your score go down. And that's why they said when this stuff goes into action, they're saying that there's a potential 20 million American scores will go down, 40 million will go up. That's crazy. For not doing anything. For you wake up one morning, you either hit the lottery right here, or you hit this one here where your scores went down. And I already know the phone call is going to be coming. I'm hoping that my clients are watching my videos because I already know the phone call is going to be coming when they put that into action. Now, let's talk about one of the benefits that I believe is going to be a major benefit, is that if they're going to play that game, they always put the game in play to benefit the lenders, and they always accidentally, because of either outsmarting themselves, is they bring another player back into the game. And I believe that trade lines, AU trade lines that are seasoned properly, even if it only has 2 years history, even if it only has 1 year history, it has to, as long as that individual who had that that credit card that you're utilizing had good trended data, 24 months plus, it has to work in your favor to boost your scores even higher than what the trade lines used to give to people, the AU trade lines. I think that it's going to make it, it's going to probably blow up the authorized user trade line business again because of that, because they've outsmarted themselves by doing, making these changes with the FICO 10. It has to, like logically, it has to give it more weight. Like unintentionally by doing this, it has to give it more weight. Has to give it more weight. All right, thank you for your time. Please like this video. Please subscribe to the channel. Please post your questions and comments. If you need help with your credit, please visit us at thecreditrepairshop.com. Watch the video, what makes us different, so you can see my 8-point validation process and my 2-phase settlement process. Thank you to everyone who posted your questions and comments. I really appreciate it. I do my best to get in there and answer those directly. I don't have someone else answering them. So some of the times, you know, it's hard, but I do my best on it. And I'm going to keep doing my best. If you need your credit reports and scores, go to the website, yourorder3scores.com. Links are below this video that has all the links. If you have debt collectors coming after you, grab my 3-pack of letters. Please make a donation on that, because those letters can literally save you time, money, frustration, all of that. I put a lot into that stuff. This is not template. This is stuff that works here for us all the time. And I have another one that's $29.95. You can grab those. I mean, just everything I do, I put my all into it. That's just the way it is. I put my all into it. Thank you for your time. This is Stephen A. Williams, President.